Happy New Year and welcome to the first quarterly video for 2026 for the Magellan Global Opportunities strategies. My name is Alyssa DeMarco, Investment Director at Magellan, and today I'm joined by Alan Pullen, Portfolio Manager, and Ryan Joyce, Deputy Portfolio Manager. Welcome, Ryan and Alan.
Hi, Alyssa.
The new year is a great time for reflection and forecasting. Alan, starting with you, can you kind of give us a little bit of a reflection on 2025, talking through the performance of the fund and your key observations?
Well, it was a noisy year, let's be honest. If we remember all the way back to Q1, and we had the talk of tariffs, and we actually had a very weak market in the US, in particular in Q1, and a lot of outperformance in Europe over that first quarter as well. But post-Liberation Day, very strong rally in markets, very strong rally in AI linked stocks as well. And this is despite what was going on around the world. And you think about wars in the Middle East, ongoing wars in Ukraine, debate around inflation, about unemployment and growth. So it was a bit of a noisy year. Overall, a reasonably positive return for markets, up in double-digit levels again in Australian dollar terms, more in US dollar terms. And that really goes to the underlying strength of the stocks, which is what we spend most of our time doing here at Magellan, looking at those underlying companies that make up the portfolio and what they're doing and how they're delivering. And they delivered another pretty solid year overall, double-digit earnings growth, projected to be double-digit again in 2026 across the portfolio. So that's the long-term drivers of returns that we're really focusing on in this strategy, albeit you do get the noise and what's happening in markets, obviously influencing shorter-term outcomes. So overall, a pretty solid year for the strategy. It outperformed the market over the year. That's notwithstanding a slightly defensive tilt to the portfolio. If you recall, this portfolio can take market-type levels of risk and can lean in and out a little bit, depending on the opportunities we're seeing. And just given starting valuations at the beginning of this year were relatively high, and there's risks around kind of tariffs and Trumps and economic growth, we were a little more modestly defensively positioned. But strong bottom-up stock selection still allowed us to deliver outperformance over the year, which is pleasing.
So Alan just spoke about the importance of that bottom-up stock selection. Ryan, could you talk us through some of the key contributors for 2025 and then their role in the portfolio going forward?
Absolutely. So I think we're pretty excited about the portfolio as we enter 2026. So it's a little tough to pick out just two of our favourites, but I thought for today we might focus on two of the lesser known companies that contributed to returns in 2025 and which we also remain excited about the prospective returns going forward. And those are Dollar General and Thermo Fisher. So starting with Dollar General, it is a US-based discount retailer that predominantly serves low-income consumers in rural areas. It's a big business, has 20,000 stores, and it had really been through the ringer over the past 3 or 4 years. During COVID times, there was a lot of handouts, a lot of stimulus provided. Their core customer had a lot more money than was typically the case, and they were spending that money. It was easy times for the store. At the same time, the stores or the management team of the business didn't really recognize this. They started assuming this would go on forever. They mismanaged the business, frankly. And so as that transition from this stimulus period to a period of inflation in your necessities that impacts that low-income consumer the most, there was a lot of pressure on the business model. And we went in, we had a look at what was going on at the business. And I think our observation was, yes, there is pressure on the core consumer. And yes, the business was over-earning when they were full, their pockets were full. But as I said, the business had been managed very poorly. The old management team was kicked out. They brought in a new management team. And they did a bunch of things. They all sound very simple. Things like improving inventory, making sure the inventory is on the shelf, making sure the right stuff is turning up to the stores, making sure there's people at the front of the store to greet them and help them check out, not having too much employee turnover. So all very simple stuff, as I said, and they themselves called it back to basics. And so the view there was, yes, there's been that pressure, but there's a lot of opportunity for them to improve the operations of their stores and restore that profitability. And that's what we've seen start to play out through 2025 and into 2026. We're seeing a lot of the underlying operational metrics there improve and that profitability start to inflect. And we think the earnings power of the business is still underappreciated by the market as it continues on that upwards trajectory. And part of that is a management team that, frankly, after having disappointed investors for a few years, even though it's a change in management, they're still very cautious about not getting ahead of themselves, and they really want to underpromise and overdeliver, which is providing us an opportunity still. So that's Dollar General. The second one I mentioned is Thermo Fisher. It's a leading provider of services, of equipment, of materials to the pharmaceutical industry and the biotech industry. And Alan alluded to some of the noise that we've had through 2025. And midway through the year, we were provided a very attractive entry point to buy into Thermo Fisher. At the time, you might recall that the tariffs with China in particular impacted parts of business. Trump was very focused on US drug prices and how he could bring those down. They also still had a book of business from COVID that was rolling off and depressing growth rates. So, a lot of negative sentiment there. The biggest risk from our perspective was around what would happen with US drug pricing. Could the Trump administration make big cuts across the board that would impact R&D budgets? And, we talked to our team went and did research, and the view was that it's actually very difficult to do with the legislation that's already in place, and there wasn't really broad support to go and change this. So we were able to, as I said, buy at an attractive price. And, we fast forward to today and a lot of that noise has removed itself. He's moved on to other areas, which we can look into, and I'm sure will be a focus of future conversations. We've seen some of those COVID headwinds kind of trail off, but we still think there's more to come. So the second part of the thesis there is that a lot of these big pharma companies have large drugs that are running off patent. And so their revenue is going to go down. They need to fill that up because they need to report growth. They want to report growth. And so we've seen a real acceleration in industry acquisitions, M&A, as they buy drug candidates and licensed drug candidates very recently. And we expect over the next few years that as they look to commercialize those, and as the biotechs that got bought out and their backers recycle into new drugs and candidates, that spending will increase, and that should help support a further acceleration in that growth. So we think that's another attractive opportunity.
Thanks, Ryan. I think you've done a great job there highlighting two interesting stocks, but then the importance of active management within our stock selection process for the Global Opportunities Fund. To bring everything together today, we spoke at the beginning the importance of the new year to look towards the future. Can you talk us through how the portfolio is positioned, Alan and Ryan, and then some of the interesting positions within the portfolio?
Yeah, well, stepping back and looking at the broad market backdrop, I think we have to acknowledge that valuations are full. When we look at the market, we cannot argue that there's a lot of bargains at the aggregate level out there, just given valuations are. And that would talk to more modest returns going forward. The economic backdrop is okay at the moment. We've seen pretty mixed data. Unemployment has been a little soft in the US. Inflation is mixed. Europe's close to raising rates potentially going forward. So there is some pretty mixed economic data out there. But overall, kind of the economic backdrop has been pretty resilient to date, notwithstanding all the noise we've talked about. And our expectations for the year ahead, I guess, are that kind of continues is our base case. We've got rate cuts in the US, which are helpful. We've got the One Big Beautiful Bill giving something of a stimulus to the US consumer. But there are no shortage of risks out there. And so given starting valuations, I would say we have to maintain a somewhat defensive stance within the portfolio. And that really marries up with the bottom-up work we're doing, because when we do this bottom-up stock selection, we are seeing those defensive stocks, which have been somewhat ignored by the market, they've been chasing some of the AI darlings, for example, are actually looking to deliver double-digit returns into the medium term with very low risk. So that's quite attractive to us, given where we think the overall market is. We also see some really good opportunities still in the tech space, including the AI space. So we're being pretty selective there. but still great opportunities. Amazon, Microsoft. Microsoft is at around 25 times forward earnings at the time of recording this video. That's pretty attractive for a high quality company. So still opportunities there as well, but just a little more cautious given the overall starting valuations. Anything?
Look, I'd just add on, as you alluded to, that cautiousness on parts of the market and parts of probably the semiconductor sector, where valuations don't look outrageous, but the earnings that these businesses have ballooned massively. Perhaps they go a little bit further, but if we rewind to 12 months ago, we've seen more and more capital come into this space. First, it started with the hyperscalers CapEx, and then they started leveraging that up with debt from capital markets and the alternative investment funds. And maybe more money can come in, but there's already a lot of capital flowing in and benefiting the earnings for some of these businesses. So we remain cautious on that front.
Thank you very much, Ryan and Alan, for your insights today, and thank you for listening in. If you'd like further information on the Magellan Global Opportunities strategy, please go to the Magellan website or contact your Magellan representative. We look forward to hearing from you soon.